Now we're going to go through how we select companies to invest in. Before we do, let's zoom out for a second. The big idea here is to use trends and events happening now to work out where capital is going to go in the future. From there, we find sectors or industries that look cheap and then identify companies within those sectors to invest in. It's having the foresight, the patience, and the stomach to buy something at an incredible discount, which might lose a bit of money first of all, might gain a little bit of value, might bump and grind for a while, and then suddenly double, then triple, and then take off from there and make you look like a genius sometime later. If you haven't done so already, you should watch the previous videos on searching for asymmetry and why we look at capital flows before choosing something to invest in. Now, when we're down to choosing companies, we'll want to invest in many companies in the sector or the industry that we've chosen, not just one or two. This reduces risk while increasing our earning potential. A great ETF is one which gives you exposure to exactly what you want and little exposure to anything else. So for example, if we found a uranium miner ETF, we would want it to be comprised of only uranium miners because that's where we think the real upside is. So you should definitely be going through all the holdings in an ETF when you're looking at those to work out if it's appropriate for you. Before we do that, if you're not interested in getting stuck into the weeds and building your own little ETF, then another option is to simply buy a few of the top companies or market leaders in the space that you're looking at. So this will usually be by market cap that you determine what to get, but just keep an eye on the amount of debt that these companies hold. You're essentially looking for safe bets here. But for those who want to do the work and put together their own little ETF, well, you're going to want to start the process by using a stock screening tool of some kind. Now I'm going to use tradingview.com, which is a free service just for this example, but you might have one that you like and use already, and that's perfectly fine. What you might want to do now is just pull up long-term charts of some of these companies to make sure they all follow the broad trend of being off from their previous highs and preferably traded sideways for ages. Generally speaking, the longer something has traded sideways, the more dramatic and aggressive a move to the upside will be.
Paid Substack subscribers get full access to the asymmetric investing course. To subscribe, visit Capitalist Exploits on Substack today and sign up.